Okay. Match and Planet reviews. Okay, the first one we'll start with is Match. Okay. Currently trading 72.60. Back on May 23rd, we bought the June, July 75 calendar call spread, and we paid $1.15. And the stock was 69.74. Okay, what would have been, oh, Jaytano, thank you. My kids surely don't. Okay, what would have been the rationale for this, everybody? Thank you, David. Let me adjust that. Okay, what would have been the rationale for that? Okay, that's one good one. Vol was definitely inexpensive. What else? Okay, Ken, great. Okay, and based on the strikes that we used and where the stock was trading at the time, what would have been the approximate expected move? Okay, 6, 3, what else? Yeah, it was about $6. And that's why we chose the 75 strike with the stock trading 69 and change. You don't need the chart, Ted. You don't need it. You've got all the information in front of you why we would have chosen those strikes. Right? If it was trading 69 and change, we were targeting the 75 strike, that would have been roughly $6. And if we had that calendar spread on, we always want the stock to move where? Well, what if we had a calendar put spread on? Then we want the stock to move down. But in any trade, in any spread that we have, where do we always want the stock to move? Bingo, bingo. Always want the stock to move to the short strike. That way we maximize the amount of premium from the short option. Okay? Okay, right now, our spread is trading $1.75. We're not filled yet, right? We're trying to exit half of it there. So let's say it's trading $1.70. Unless people have gotten filled. I have not. I haven't seen any fills yet. Okay, the other thing I want to put up here for note is that one of the reasons in our rationale here we said we did this was because vol was inexpensive. Now I have this on our tracker because I track this for volatility trades. We bought the July option for a 38.31 implied volatility. It's now trading almost 40. Okay, and if we look here at our vol chart, 38 and change where we bought it. That's why we bought this volatility, because it's unbelievably cheap. Okay, so currently the spread is trading 170, and we are trying to exit half the position for $1.75. Why are we trying to exit half for $1.75? Okay, 70% target, locking in some profits, yeah. Okay, bingo. All of those are valid reasons. Okay, and in a calendar spread like this, which is less risky, and you wait for it to develop, this is phenomenal reward to risk. Okay, so let's say we get filled here for $1.75. Okay, let's look at the individual prices of the options here. Okay, let's say we get filled at $1.25 over $3, which is $1.75. Okay, if the current prices are $1.25 over $3. Okay, this kind of goes back to our discussion earlier on premium, intrinsic value, parity, what's left. Okay, how much of each of those option prices and the 75 strike is intrinsic value? How much is extrinsic value? And what is parity? Okay, how much of that, guys? Bingo. Anyone else besides Ken? Anyone else besides Ken? Okay, Ken, this is me and you, kid. You are 100% correct. It is all extrinsic. Why is it all extrinsic, everyone? Why is there no parity? Why is that? No. Kyle's got it, and Gus has it, because both options right now are out of the money. Gaetano's got it. Both options are out of the money. So the entire value of those options then is all premium. Okay? So 0 intrinsic, all extrinsic, and no parity. Because the options are out of the money. Does that make sense to everybody so far? Okay, now, why am I bringing this up? And we're going to do the same for planet, but why am I bringing this up? I know why I'm bringing it up. Okay, Michael, that's one. Still money to be made. But just as importantly, not only do I understand how much money, want to understand how much more money there is, there you go, Gus, to be made, I also want to measure what my risk is. Bingo, Gary. So at this point, we know for certainty between today and next Friday, which is expiration of the short, okay, June 21st, we know that the entire amount of our short option, which is $1.25, all of that is premium, okay, all of this premium will go to 0 by June 21st expiration, right? So we know for certain, 100% certainty, that we will make $1.25 from the short option. Okay? Right? Because we know at expiration the premium amount goes to 0. Whether the option is in the money or out of money, there's no premium left. Right? Yes, no, maybe? Okay, so if we know we are going to make that $1.25 between now and June 21st expiration, what has to happen to the stock in order for us to not lose more than that $1.25 in our long option? That's how I'm going to measure the risk. Okay, so how do we measure that? Well, what is the delta of our long option? Good, Gary. The delta is 46. Does everybody see that? Okay. What that tells me, the delta of our long July 75 call is plus 46. So what that tells me is between now and next Friday, June expiration, we have $1.25, like we said, to make in our short option. How much can the stock move in order for us not to lose $1.25 in our long option? Well, if we take $1.25 divided by the delta, that's 271, basically, 272. Right? $1.25 divided by 46 is $2.72. If we take our current stock price, which is $72.60, less the 272, that equals $69.88. What does that all mean? Before I put it up here, what does that all mean? Yes, difference between what Ken and Gary are saying there. Definitely a difference between what they are saying. Okay, so what is this saying, everybody? Come on, think about it. Okay, Pamela, it could go down to 69.88, and what would happen? If the stock went down to 69.88, nope, not break even on our trade. If the stock goes down to 69.88 by next Friday, okay, if it goes down to 69.88 at expiration, the value of the spread will be the same as it is today, which is $1.70. Right? Remember, we're measuring versus where it is today, not where we bought it at $1.10 or whatever it was, but where it is today versus expiration of the short option next Friday. So I look at this and say, okay, I know what can happen to the stock on the downside if we move there by next expiration. So I know what the value of our spread potentially is going to be. So I know where my risk is. Does that make sense? Again, trying to get you guys to think about looking into the future, kind of having that, that point guard vision so you can see the whole court so that we can be actionary instead of reactionary. Okay? Make sense? Does that help? If not, I want you guys to speak up and let me know. Okay, we can also take this one step further and say, what will be the best thing that can happen to this position over the next 11 days? Okay, and what would happen if we do go to 75? And why would that be good, bad, or indifferent? Okay, let me take this to the next page here. Okay, so this is going to be okay. If the stock rallies to 75 at expiration, why is this good? And I'm not going to go back to the theoreticals yet, to our option page yet. But if it rallies to 75, let's talk about the concepts and the theory here. Why would that be good? Okay, Russell, you got it. Kyle, you got it. Glenn, yep. Okay, why is this good? Number one, good job, guys. The short will still expire worthless, meaning we would keep the $1.25 of premium that is still in that option, right? So the value of this option, it's trading $1.25 today. It's going to be trading 0 if the stock is 75 at expiration. So we will keep all of that additional premium. Does everybody understand that part of it? Okay. Additionally, our long option will increase in value by, Ken, I think someone said it, by about $1. Let me see. Someone said that. Not sure who it was, but someone said it will increase by about $1. Oh, Kyle, it was you. Thank you. How did Kyle figure that out? And by the way, I just got filled. I literally just got filled as we're speaking here at $1.75 on half the order. Okay, great, Kyle. It will increase by about $1 because the 46 delta times approximately $2 of the increase in the stock price from where it's trading now to 75 at expiration is about 92 cents. Okay? Does everybody understand that? So we win-win. We win on the short, we win on the long. If we combine that, if we combine what we're going to gain on the short and what we're going to potentially gain on the long, the value of this spread could really go up by over $2. Does everybody get that from the mathematical part? Because now I'm going to show you the chart why that's true. But I wanted you to all work through the math and concepts first before looking at the chart. No, Ken. That's 2 up from where it's trading right now. Right now it's trading at $1.70, $1.75. That's an additional $2 from this point. Between, again, the short premium that we would make off the short option and the long delta in our long option. Now, there is one, no, Ken, it's $1.25 in the short plus roughly $1 in the long. Right. Now, there is one thing we haven't factored in here which would work against us a little bit. What one factor haven't we brought in yet? No? Well, vol is one, but let's assume vol stays the same. Okay? Not gamma, David. Although that would increase the rate of delta a little bit. There you go. Theta of what, Pamela? And what do you mean by time, Frank? That is what I'm looking for. But tell me about that. Yeah, the theta or premium decrease of our long option. Okay? Not going to be a lot because it's still going to be over a month away. But that will affect the value of that option a little bit. Okay, now, check this out. This is what the graph of our position looks like today. Okay? And as you can see with the stock, and the stock's almost 73 now, but right here, it's showing 0 P&L because it is what it is right now. That's $1.70 or $1.75, whatever it is right now. Okay? But watch what happens. Watch what happens as I change the date here and move ahead in time. Okay? Watch what happens when I go all the way to expiration. Look what happened here. Remember, we were talking about 75 at expiration, so let's put that in here. This is showing a gain from this point forward of $1.60. Everybody see that? So if we were to push the date ahead to expiration, this is telling us that we would pick up $1.60. Not the $2 we had calculated, but $1.60. Okay, why? Why is it only... No, this is the entire spread, Pamela. Why is it $1.60 and not the $2 or $2 and change? Bingo, nicely done. The chart shows that the spread will be 160 higher at expiration. This is because there will be approximately 40-ish cents of theta in our long option between now and expiration. Make sense to everybody? I know there's a lot of moving pieces here, but if we, get this all on paper, look at the chart, look at the graph, hopefully those pieces come together. Awesome. All right, enough on this. We can go through the one for Planet also. It's going to be the exact same thing conceptually. If you'd like to do it, I will gladly do it. It's going to be the exact same conversation, just using Planet in those options instead. Gus, I'll show that to you in a moment. Let me wrap this up and I'll be right back.